Much of the slowdown was engineered by the Chinese authorities themselves in trying to deal with too much debt, trying to pop their own debt bubble. But on top of it, we've had these trade tensions between the U.S. and China, which is obviously feeding in the numbers. And then just long term, the maturation of the economy, they're moving into a different development path. So all these things are weighing on growth. And I suspect we'll see more of what we saw today.
The stimulus that we've seen from the Chinese has largely been focused around the triple R and providing liquidity, it seems, rather than providing the kind of stimulus to credit growth that we've had before from the Chinese government.
Indeed.
It's a different approach to the way they're trying to fine-tune the economy. Why are they pursuing that path rather than a bit more shock and awe?
Well, I think they're avoiding the shock and awe. I think they're looking for more sustainable, more moderate growth rather than what we've seen in previous episodes. I think they want to avoid another debt buildup. They really are looking more at the long term rather than the short term.
When we look at the noises around the trade story at the moment, it's very difficult for the markets to read whether a deal is close to being signed here that is more comprehensive. Mr. Mnuchin suggesting there is a possibility of a signature on a piece of paper sometime next month. What are you hearing? How optimistic are you?
I think we saw a mini deal, which is basically a truce, and I think actually they could have had that deal 18 months ago. So it's unfortunate we've had close to 2 years of noise with something we could have gotten. I'm skeptical you get a comprehensive deal. The issues are really complex, and I'm not sure the president wants a deal in the short term. I think he wants enough to keep the markets buoyant, but I think he wants to continue attacking the Chinese for political purposes in the 2020 election cycle.
Which is not a good news story necessarily for the financial economy. What do you think the consequences are going to be for where we sit on key market levels and the amount of money that seems to be finding its way into fixed income instruments?
Well, I think markets continue to try to look through the U.S.-China tensions. There's a lot of noise there. We do see some movement in supply chains to other parts of the world. But I think there is just trying to manage through what may be a permanent fixture in U.S. foreign policy with respect to China. I think we are in a Cold War, a modern version of a Cold War.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.